Something unprecedented just happened on January 1st, 2026, and almost nobody noticed. The world's most infamous silver manipulator just became the world's largest silver hoarder on the exact same day that China cut off more than half the global supply. You're probably wondering how that's even possible. Well, let me walk you through what just happened. For over a decade, JP Morgan has been the villain in silver markets. They've been accused of suppressing prices through massive short positions, essentially betting against the metal rising. They paid nearly $1 billion in fines for spoofing and manipulation. Traders watched them dump paper contracts to crush rallies. The bank became synonymous with keeping silver artificially cheap. Everyone in precious metals knew their game. Then something extraordinary happened. According to multiple industry sources and regulatory filings, JP Morgan didn't just exit their short position. They flipped entirely to the other side. The bank that once held short positions on 200 million ounces of silver quietly accumulated a physical stockpile of 750 million ounces. That's not a typo. 750 million ounces of actual metal worth over $40 billion at current prices. Let me put that in perspective for you. Global silver mines produce roughly 830 million ounces per year. JP Morgan now controls nearly an entire year's worth of worldwide production sitting in vaults with their name on it. It's the largest private silver hoard in modern history. And they built it while everyone was watching their left hand, assuming they were still manipulating prices downward. Here's where it gets interesting. That same January 1st date wasn't chosen randomly by China's Ministry of Commerce. New export licensing requirements took effect today that fundamentally reshape who can sell refined silver to international markets. The rules sound bureaucratic on paper. Exporters must prove they produced at least 80 tons annually and maintained consistent export records from 2022 through 2024. But here's what those requirements actually did. They just wiped out the small and mid-sized Chinese refiners who've been supplying global markets for years. If you didn't have the scale and paperwork trail from 3 straight years, you're done. You can refine all the silver you want for domestic Chinese buyers, but you cannot export a single ounce to the rest of us. And here's the thing you need to understand about China's role in this market. China refines somewhere between 60 and 70% of the world's silver supply. Think about that number for a second. More than half of all the refined silver that powers our solar panels, electronics, medical equipment, and industrial applications flows through Chinese facilities. And as of this morning, a significant portion of those facilities can no longer sell to international buyers. The timing is remarkable. On the exact day that JP Morgan's accumulation strategy reaches full maturity, with 750 million ounces secured, China implements export controls that will strangle supply to everyone else who needs physical metal. You might be thinking this is coincidence. You might believe that JP Morgan just got lucky with their timing, and China's regulatory changes just happen to align. But then you look at what's been happening in the actual delivery markets and a different picture emerges. In December 2025, something broke at the COMEX Futures Exchange in New York. Over just 4 trading days, market participants stood for delivery on 47.6 million ounces of silver. That's 60% of the entire registered inventory available for delivery claimed in less than a week. These weren't speculators rolling contracts forward. These were buyers demanding actual metal. The Chicago Mercantile Exchange responded with Advisory 25393, dramatically raising margin requirements to $25,000 per contract. When an exchange suddenly makes it much more expensive to hold positions, they're not doing it because markets are calm. They're doing it because they're terrified of what happens if the delivery demands continue. What should grab your attention is that these weren't isolated incidents across different markets. This was coordinated. JP Morgan completes the largest physical accumulation in history. China restricts exports from the world's dominant refining center. And COMEX nearly runs out of deliverable silver in the same month. Have you noticed what's not happening? There's no announcement, no press conference, no official statement explaining why the world's silver supply chain just got cut off at the knees. We're discovering this by watching regulatory filings, tracking vault inventories, and connecting the dots that major institutions would prefer stay disconnected. Let me paint you a scenario. You're an industrial buyer in Germany who manufactures solar panels. You've been purchasing silver from the same Chinese suppliers for years. Your production lines need steady flows of refined metal to keep operating. And you wake up on January 2nd to discover that most of your suppliers can no longer export to you. What do? You panic. You call every available source. You check COMEX inventories and see they're already depleted from December's delivery surge. You look at London vaults and find they've lost 40% of their holdings. You reach out to other refiners and discover they're facing the same supply restrictions. And then you realize something terrifying. There might not be enough accessible silver to keep your factory running at full capacity, but that's just one manufacturer, and the problem runs much deeper than that. Now multiply that scenario across thousands of industrial users worldwide. Solar manufacturers, electronics companies, medical device producers, defense contractors, automotive suppliers. Every single one of them just discovered their supply chain has a massive new choke point, and there's no quick solution. According to the Silver Institute's most recent data, global silver demand reached 1.24 billion ounces in 2025. Total supply from mining and recycling delivered only 1.01 billion ounces. That's the sixth consecutive year we've consumed more silver than we produced. We've been running deficits for over half a decade. And the only reason prices stayed manageable was because existing stockpiles and paper contracts created the illusion of abundant supply. China's export restrictions just shattered that illusion. The paper contracts still exist, but the physical metal to back them is increasingly locked behind regulatory walls. And JP Morgan, the same institution that allegedly suppressed prices for a decade, now sits on a stockpile that could supply nearly the entire annual global deficit by themselves. Think about the psychology here. If you're holding paper silver contracts right now, what's your confidence level that you'll actually receive physical metal when you demand delivery? After watching 60% of COMEX registered inventory disappear in 4 days, after seeing China cut off the majority of global refining capacity, after learning that the biggest player in the market switched from shorting to hoarding, this isn't a normal market transition. This is the setup for something much larger, and the pieces just locked into place on New Year's Day. The world's supply is restricted, the exchange inventories are depleted, and the smart money already positioned itself on the long side before any of us realized what was happening. What comes next isn't speculation, it's mathematics, and the numbers are about to force a reckoning that paper contracts can no longer postpone. The gap between paper prices and physical reality started appearing in the one place that always tells the truth. The premium buyers pay for actual metal versus futures contracts. In late 2025, physical silver in Shanghai began trading at $8 per ounce above COMEX futures prices. Let me explain why that number should terrify anyone who understands commodity markets. In normal conditions, prices across global exchanges stay relatively aligned through arbitrage. If silver is cheaper in New York than Shanghai, traders buy in New York and sell in Shanghai until prices equalize. An $8 sustained premium means that arbitrage mechanism is broken. This is called backwardation, and it's the market screaming that people with physical metal won't sell at paper contract prices because they know the physical is worth more. When spot prices exceed futures prices by this magnitude, you're watching the paper pricing system lose credibility in real time. Industrial buyers in China are paying massive premiums because they need actual silver for production, and they've learned that COMEX contract prices no longer reflect the cost of securing deliverable metal. According to data from the Shanghai Futures Exchange, this premium persisted for weeks, not days. That's not a temporary dislocation from a single large order. That's a structural disconnect between two different markets. And what's driving this disconnect goes back years. One market is trading promises of silver and one trading actual silver. And the actual silver commands a premium that tells you physical scarcity is already here. Now let's talk about why that scarcity is mathematical, not temporary. The World Gold Council and Silver Institute have documented something remarkable in their supply-demand data. We've been consuming more silver than we produce for 6 straight years. In 2025, demand reached 1.24 billion ounces, while total supply from mining and recycling delivered only 1.01 billion ounces. That's a deficit of 230 million ounces in a single year. Where did those extra 230 million ounces come from? Existing stockpiles, vault inventories, the reserves that built up during previous surplus years. But here's the problem with deficits. They're cumulative. 6 years of consuming more than you produce means you've drawn down approximately 1.2 billion ounces from global stockpiles. That's more than an entire year's worth of total production just vanished from available inventory. You might think mining companies could simply produce more to close the gap, but silver supply doesn't work that way. According to the U.S. Geological Survey, roughly 70% of silver production comes as a byproduct of mining other metals, primarily copper, lead, and zinc. You can't just mine more silver without also mining more of those base metals, and those markets have their own supply-demand dynamics that don't care about silver shortages. Meanwhile, demand isn't slowing down. Solar panel manufacturers alone consumed over 200 million ounces of silver in 2025. And that number is growing at double-digit annual rates as countries accelerate renewable energy installations. The photovoltaic industry now represents roughly 20% of total silver demand, and every projection shows that percentage increasing through 2030. These are not discretionary purchases that can wait for better prices. These are industrial requirements for production lines that run continuously. Think about a solar manufacturer in India who's contracted to deliver panels for a massive installation project. They need silver paste for electrical contacts. They need it on schedule. If the price rises, they pay it. If the premium widens, they pay it, because the alternative is shutting down production and defaulting on contracts worth far more than the cost of the silver. This is price inelastic demand, and it's growing faster than new supply can materialize. Then we have the regulatory panic signals that confirm this isn't just market observers being alarmist. When exchanges and vaults start behaving erratically, they're telling you something is deeply wrong behind the scenes. Shanghai Futures Exchange inventories collapsed to 715 tons by late 2025, the lowest level since July 2016, and down 86% from the 2020 peak. That's not a gradual drawdown. That's a liquidity crisis where available metal is being pulled faster than it's being replaced. The LBMA vaults in London, traditionally one of the deepest pools of precious metals liquidity in the world, lost 40% of their silver holdings over the same period. And COMEX registered stocks, the silver actually available for delivery against futures contracts, fell 70% since 2020. We're not talking about total vault holdings. We're talking specifically about the metal that's available to satisfy delivery demands. That category has been absolutely gutted. But what the institutions did next tells you everything about how serious this really is. COMEX registered stocks dropped from over 200 million ounces to roughly 80 million ounces today. What's remarkable is how these institutions responded. The CME didn't just raise margin requirements once, they've done it repeatedly, making it progressively more expensive to hold positions that demand physical delivery. Shanghai implemented stricter delivery protocols. The LBMA tightened access requirements for vault participants. These aren't the actions of confident market operators. These are defensive moves from institutions that fear a run on physical metal they can't satisfy. Have you noticed the pattern? Every major silver trading venue simultaneously reducing accessible inventory while making it harder to demand delivery. That's coordinated crisis management, not coincidence. When regulators across different continents start implementing similar defensive measures at the same time, they're responding to a common threat they don't want to publicly acknowledge. Let's connect this to China's export restrictions. When a country that refines 60 to 70% of global supply suddenly requires exporters to prove 3 consecutive years of large-scale production and export records, they're not just implementing bureaucratic oversight. They're creating a cartel of approved exporters, large state-aligned refiners who will operate under government guidance, while smaller competitors get shut out of international markets. The Chinese government has watched what happened to rare earth elements where they dominated production, but lost pricing power. They've studied how commodity pricing works in Western financial markets, where paper contracts can suppress prices even when physical scarcity exists. And they've apparently decided that controlling refining capacity gives them leverage that's too valuable to leave unregulated. Put yourself in the position of a Chinese policymaker watching global silver markets. You see structural deficits every year. You see Western exchanges depleting inventories. You see industrial demand accelerating for strategic technologies like solar panels and electric vehicles. You control the majority of global refining capacity. What do? You implement export licensing requirements that let you control who sells to whom, at what volume, and under what conditions. You ensure that Chinese domestic industries have priority access to refined silver before any gets exported. You create a system where international buyers become dependent on your approval for supply continuity, and you do it all under the bureaucratic cover of standardizing export procedures. According to industry analysts tracking Chinese metals policy, the Ministry of Commerce has been methodically applying this playbook across strategic commodities. Rare earths went first. Tungsten and antimony followed. Now it's silver's turn. And the timing suggests they understand something urgent is happening in global markets. Because here's what the data reveals when you look at the full picture. Industrial demand rising at 8 to 10% annually. Mine supply essentially flat or slightly declining. 6 consecutive years of deficits drawing down stockpiles. Exchange inventories at multi-year lows, the world's dominant refiner implementing export controls, and the historically largest short seller now holding the historically largest long position. Every single piece of evidence points to the same conclusion. The physical silver market is fundamentally short, and the paper contract system that's been masking that shortage is losing credibility. When Shanghai trades at an $8 premium to COMEX, that premium is the market's way of saying paper prices are fiction and physical prices are reality. And there's research that explains exactly why this matters. The World Bank published research on commodity market structure that explains exactly what's happening. When futures markets lose the ability to deliver physical commodities against contracts, they transition from price discovery mechanisms to speculative casinos. The prices still move, but they stop reflecting actual supply-demand fundamentals because the connection to physical delivery is broken. We're watching that transition happen in real time. COMEX can still trade silver futures contracts all day long, but when 60% of deliverable inventory gets claimed in 4 days, and the exchange responds by raising margin requirements, they're admitting they can't support physical delivery at current contract volumes. The system works as long as most participants settle in cash. It breaks when everyone demands actual metal, and JP Morgan, they apparently saw this coming years ago and positioned themselves accordingly. While they were publicly shorting paper contracts and paying fines for manipulation, they were quietly acquiring the largest physical stockpile in modern history. That's not contradictory. That's brilliant. Suppress paper prices through short selling while accumulating physical metal at artificially low prices. Then flip to the long side when supply restrictions make physical scarcity unavoidable. The convergence we're witnessing isn't coincidence. It's the end result of structural deficits meeting supply restrictions, meeting inventory depletion. And the mathematics of what happens next are becoming unavoidable. Let's do the math that everyone in precious metals is quietly running, but nobody wants to say out loud. China's export restrictions don't need to eliminate all international supply to break the market. They just need to reduce it enough that annual deficits become impossible to cover from existing stockpiles. If those restrictions cut available exports by even 50%, we're looking at an additional supply reduction of roughly 160 million ounces per year hitting international markets. Remember, we're already running deficits of 230 million ounces annually before China's restrictions. Add another 160 million ounces of constrained supply, and you're looking at annual global deficits approaching 400 million ounces. Now, look at COMEX registered inventory currently sitting around 80 million ounces total. At that deficit rate, some regions have approximately 30 to 45 days of accessible reserves. Think about what that means for our industrial economy. A solar panel manufacturer does not have the luxury of waiting 6 months for new mine supply to come online. An electronics company can't tell customers their products are delayed indefinitely because silver is unavailable. A medical device producer can't halt production of critical equipment because commodity markets are dislocated. These industries operate on just-in-time supply chains that assume continuous material availability. What happens when that assumption breaks? Prices don't rise gradually. They spike vertically as buyers compete for whatever physical metal remains accessible. We've seen this movie before in other commodity markets. When supply truly tightens, prices don't move in orderly fashion. They explode. The technical chart patterns are telling the same story, and when you look at historical precedent, the numbers become even more striking. Silver spent 40 years forming what technical analysts call a cup and handle pattern, consolidating below the 1980 peak of $50 per ounce and building a massive base. In 2025, silver finally broke out decisively above $30, confirming the pattern and suggesting the beginning of a major bull cycle. If we look at the previous cycle from 1993 to 2011, silver delivered gains of 747% from its low point. The metal went from under $4 per ounce to nearly $50 over that 18-year period. We're now in a similar setup, but with fundamentally tighter supply conditions than existed during that earlier run. Applying similar momentum from the current $30 breakout level points toward potential targets in the $250 to $300 per ounce range if this cycle matches the previous one's intensity. But here's what makes this different. The 1993 to 2011 cycle happened during years of supply surplus. We weren't running structural deficits back then. We didn't have China controlling the majority of refining capacity. We didn't have solar demand consuming 200 million ounces annually. The psychological level that's likely to get tested first is $100 per ounce. That's a clean round number that will attract massive attention when silver approaches it. Media coverage will explode, retail investors will pile in, and industrial buyers will panic purchase to secure supply before prices go even higher. But there's another ratio that's equally important, the gold to silver ratio, which currently sits around 75 to 1. That means it takes 75 ounces of silver to equal the value of 1 ounce of gold. Historically, that ratio has averaged closer to 33 to 35 to 1 over long time periods. If gold is trading around $2,600 per ounce and the ratio compresses to historical norms, that puts silver at $74 to $78 per ounce just from ratio normalization before accounting for any supply crisis premium. Now combine ratio compression with supply shortage dynamics, and you get price targets that sound absurd until you run the numbers. If silver reaches $100 while gold stays relatively stable, you're looking at a ratio around 26 to 1. That's not unprecedented. The ratio hit 15 to 1 during the 1980 peak. When physical scarcity meets industrial panic, historical ratios become irrelevant because the math of supply and demand overrides everything else. Here's the scenario that keeps risk managers awake at night. What if COMEX can't deliver against a major contract expiration? What if too many holders stand for delivery and the exchange simply does not have enough registered inventory to satisfy demand? The industry term for this is force majeure, a failure to deliver due to circumstances beyond reasonable control. According to commodity market analysts, a COMEX force majeure declaration in silver would be catastrophic for the entire precious metals complex. It would prove that paper contract prices have completely disconnected from physical availability. Every industrial buyer would immediately attempt to secure physical metal regardless of price. Every investor holding paper contracts would demand delivery or liquidate. And prices would enter what traders call a blue sky breakout, where traditional valuation models become meaningless because supply has actually run out. But there's historical context that makes this even more alarming. The 1980 Hunt Brothers squeeze saw silver reach $140 per ounce in inflation-adjusted terms, but that was driven by speculative hoarding, the Hunt family trying to corner the market through futures contracts. What we're facing now is potentially worse because it's driven by genuine industrial scarcity. When speculation drives a squeeze, it eventually collapses as speculators take profits. When industrial shortage drives prices, they stay elevated until new supply comes online or demand gets destroyed through recession. Think about the position of institutional investors right now. If you're managing a pension fund or endowment, what's your risk assessment of holding silver exposure? On one side, you have the potential for massive upside if supply crisis scenarios play out. On the other side, you have the risk of being early if the crisis takes longer to materialize. But here's the asymmetry. Being early costs you opportunity, while being late costs you the entire move. That's why JP Morgan's positioning is so revealing. They didn't accumulate 750 million ounces because they thought silver might drift slightly higher. You don't build a $40 billion physical position for modest gains. You build it because you're positioning for a fundamental repricing that makes current levels look absurdly cheap. The Bank for International Settlements has published research on commodity market dynamics during supply disruptions, and their findings are instructive. When physical shortages emerge in globally traded commodities, prices typically overshoot fundamental values by significant margins during the adjustment phase. Market participants underestimate how quickly supply can respond, then panic when they realize new production takes years, not months, to materialize. In silver's case, even if prices triple tomorrow, you can't just open new mines next quarter. According to mining industry data, bringing a new silver mine from discovery to production takes 7 to 10 years on average. Expanding existing operations takes 2 to 3 years minimum. And remember, 70% of silver comes as a byproduct of other metals, so increasing silver output requires economic justification for mining more copper, lead, and zinc, which have their own market dynamics. Recycling could theoretically increase, but the Silver Institute's data shows recycling already operates near maximum efficiency for most applications. You can recycle silver from industrial scrap and old electronics, but you can't recycle silver that's been consumed in solar panels mounted on roofs or embedded in electronics still in use. That metal is effectively removed from available supply for decades. So we have demand that's price inelastic in the short term, supply that can't meaningfully increase for years, inventory that's been depleted to multi-decade lows, and a major refiner implementing export restrictions that further constrain available metal. What does basic economics tell you happens to price when demand exceeds supply, and new supply can't materialize quickly? Let me put this in terms of your personal finances. If you're holding retirement savings, how are you positioned for commodity inflation? If you're planning major purchases, have you considered that the electronics you want to buy might cost significantly more if silver triples? But it's not just about individual finances anymore. If you're invested in solar energy stocks, do you understand that their input costs are about to potentially explode? This isn't fear-mongering. This is looking at documented supply deficits, confirmed export restrictions, verified inventory depletion, and asking what happens when those trends continue. The mathematics doesn't care about our comfort level with the conclusion. There's a reason JP Morgan flipped from the world's largest short to the world's largest long position. There's a reason China implemented export controls on January 1st. There's a reason COMEX raised margin requirements after 60% of registered inventory got claimed in 4 days. These aren't independent events. They're coordinated responses to the same underlying reality. Physical silver is genuinely scarce, and the paper contract system can't hide that scarcity much longer. When the gap between paper prices and physical reality becomes too obvious to ignore, one of two things happens. Either paper prices rise dramatically to meet physical reality, or the paper market loses credibility entirely and physical-only pricing takes over. Both scenarios result in significantly higher silver prices. The only question is whether the transition happens in an orderly way or through market disruption. History suggests disruption is more likely. Commodity markets don't tend to smoothly adjust to supply shocks. They tend to ignore warning signs until crisis forces immediate repricing. We're seeing all the warning signs right now. Backwardation in Shanghai, inventory depletion across exchanges, export restrictions from the dominant refiner, institutional positioning by the smartest money in precious metals. The setup is complete. The pieces are in position. And January 1st, 2026 might be remembered as the day the physical silver shortage became unavoidable. What happens next won't be speculation or prediction. It will be mathematics playing out in real time as supply, demand, and price finally align. Whether you're an investor, an industrial buyer, or someone just trying to understand what's happening in commodity markets, the message is clear. We're watching a fundamental repricing event begin. And the institutions that positioned for it years in advance are about to look very smart, while the rest of us figure out what just happened to silver markets. The question isn't whether prices will rise. The question is how high they'll go before supply and demand find a new equilibrium. And based on everything we've examined, the mathematics suggests much, much higher than most people currently imagine. Every single data point we've looked at confirms the same pattern. JP Morgan's 750 million ounce accumulation. China's export restrictions eliminating 60 to 70% of global refining capacity from international markets. COMEX's 70% inventory depletion. Shanghai's persistent $8 premium over paper prices. 6 consecutive years of structural deficits totaling 1.2 billion ounces drawn from stockpiles. Industrial demand growing at 8 to 10% annually while mine supply stays flat. The inability to bring new production online for 7 to 10 years, even if prices spike. The coordinated defensive measures by exchanges worldwide. The force majeure risk hanging over the entire paper contract system. You're watching the early stages of something that could reshape commodity markets for years to come. Think about what needs to happen for this situation to resolve. Either industrial buyers need to drastically cut their silver consumption, which isn't possible when you're manufacturing solar panels and electronics with existing production commitments, or mining companies need to dramatically increase supply, which takes close to a decade for new mines and several years even for expansions. Or recycling needs to somehow recover hundreds of millions of ounces from products still in active use, which violates the laws of physics. Or China needs to reverse their export restrictions and allow unrestricted flow of refined silver to international markets, which contradicts their strategic resource policy across multiple commodities. None of those scenarios are likely, which means the only variable that can adjust quickly is price. And when price is the only mechanism available to balance supply and demand, it doesn't adjust gently, it adjusts violently. We're talking about a market where annual demand exceeds supply by potentially 400 million ounces once China's restrictions fully take effect, where COMEX has only 80 million ounces of registered inventory available for delivery, where the largest institutional player just accumulated nearly a full year's worth of global mine production, where industrial buyers can't stop purchasing because their production lines depend on continuous supply, where new mining supply can't materialize for years regardless of price. That's not a market heading for modest price appreciation. That's a market heading for a supply crisis that forces price to levels that seem impossible until you realize there's no other way to ration scarce physical metal among desperate buyers. The premium in Shanghai is already telling you this story. When physical metal trades $8 above paper prices for weeks at a time, the market is screaming that paper no longer reflects reality. Industrial buyers in China are paying that premium because they need actual silver, and they've learned that COMEX contracts don't guarantee delivery. Now imagine that premium spreading to every major market as buyers worldwide realize the same thing. Imagine European manufacturers, American defense contractors, Japanese electronics companies all simultaneously trying to secure physical silver from a supply base that just got cut in half by Chinese export restrictions. Imagine them bidding against each other while COMEX inventories continue depleting, and JP Morgan sits on their 750 million ounce hoard watching prices rise. That's not speculation about what might happen. That's extrapolating from what's already happening in Shanghai, what already happened at COMEX in December, What China already implemented on January 1st and what JP Morgan already accumulated over the past decade, the setup is already complete. The trigger was already pulled. We're just watching the consequences unfold in slow motion as industrial buyers gradually realize their supply chains have been fundamentally disrupted, as exchanges gradually admit they can't support unlimited delivery demands, as paper prices gradually lose credibility relative to physical premiums, as the gap between futures contracts and physical reality gradually becomes too wide to ignore. January 1st, 2026 was the day everything changed. The world's largest short became the world's largest long. The world's largest refiner locked down exports. The paper pricing system started breaking, and the mathematics of supply and demand began forcing a reckoning that no amount of futures contracts can prevent.